Okay, let's just dive right in. This week, a single deal absolutely shook up the market, and it tells us pretty much everything we need to know about where big money is headed. We are talking about a move that signals the return of the mega deal, and more importantly, it shines a light on a powerful and kinda hidden force that's reshaping global finance. So, what's the magic number? It's this: $18.3 billion. That was the number that grabbed all the headlines. I mean, a price tag that big could fundamentally change the game for an entire industry. So you have to wonder, right? What on earth does $18.3 billion actually buy you in today's market? Is it the next huge AI company? Maybe a global shipping empire? What is it? Well, the answer is a healthcare technology company. This is what's known as a take-private deal. You've got two buyout giants, Blackstone and TPG, and they're basically swooping in, buying a public company and yanking it right off the stock market. And to pull this off, they're using a classic Wall Street move, the leveraged buyout. The engine behind this whole thing is a leveraged buyout, or LBO. And the key word here is leverage, because that $18 billion price tag, that's not all cash. No way. A huge chunk of it is borrowed money, and that debt gets placed right onto the company that's being bought. So let's get specific. Who is at the center of this mega deal? The company's name is Hologic. And the big question is, why them? Why are two of the world's biggest private equity firms willing to borrow so much money for this one company? It's because Hologic is exactly what investors are dreaming about in a world with high interest rates. It's a huge player in women's health, which is an industry that holds up pretty well even when the economy gets rocky. But here's the most important part. It generates stable, predictable cash, month after month. It's not some risky startup. It's a reliable, bona fide cash flow machine. And that cash is precisely what you need to pay down all that debt. And you know what? This deal follows the classic private equity playbook, almost to a T. Blackstone and TPG aren't really betting on inventing some revolutionary new medical device. Nope, they're betting on efficiency. The game plan is simple. Buy the company, streamline everything, cut costs, pour money into the parts that are already making a killing, and then in about 5 to 7 years, sell it for a massive profit. But wait a minute. How in the world do you get the money for a deal this enormous, especially right now when traditional banks are being a lot more careful? Well, this brings us to the real powerhouse funding today's biggest deals. The answer is something called private credit. I want you to think of it like a parallel universe to the traditional banking system. These aren't banks. They're massive investment funds that lend money directly to companies, completely outside of the public markets. Okay, so why are these giant firms turning to private credit instead of just going to a bank? Well, it really boils down to two huge advantages: speed and certainty. A private credit fund can say yes to billions of dollars incredibly fast, and that gives a buyer a massive, massive competitive edge when they're in an auction trying to win a company like Hologic. And listen, this is not some tiny niche market anymore. Private credit is now a multi-trillion-dollar asset class, and it's going global. Just as an example, a firm called Enco Capital just locked down $100 million for a private credit fund focused just on Africa. It just goes to show you this model is expanding way beyond just the US and Europe. Okay, so buying companies with all this private money, that part is absolutely booming. But there's a huge, huge problem brewing on the other side of the deal: actually selling them. The traditional exit ramp for these investments, it's seriously clogged up. And look, we're seeing this play out in real time. CVC Capital Partners, another one of these private equity giants, just had to cancel the initial public offering, the IPO, for its Japanese company Fine Today. I mean, they were all set to sell it on the stock market, and then at the last minute, they pulled the plug. Why? It's because the public markets are being extremely picky right now. Investors don't just want any old company. They're looking for super high-growth tech or essential infrastructure. For a consumer company like Fine Today, CVC probably looked at the numbers and realized the price they'd get from public investors was just way too low. It wouldn't deliver that great return they promised their own backers. So this creates a massive dilemma, right? If you're a private equity firm and the door to the stock market is slammed shut, how do you get cash back to your investors who are all expecting a nice payout? Well, you get creative. You pull out a tool called a continuation fund. Now, it's a little bit controversial, but here's the gist. In essence, the private equity firm sells the company to itself. They set up a brand new fund to buy the company from their old fund. This lets them give cash back to their original investors while still holding onto the company, hoping they can sell it for a better price later on. So let's just take a step back here. What we're really seeing is a system that's getting seriously unbalanced. It's being fueled by enormous, fast-moving private money on the way in, but the traditional, public ways out are getting blocked. And you have to ask, what does that mean for the financial system as a whole? And this really shows the whole issue in a nutshell. We have these gigantic private deals happening, but the public market exit, it's barely a trickle. And because this is all happening behind closed doors, the overall transparency of the system is incredibly low. And that lack of transparency, that's where the real risk is hiding. See, unlike bank debt, which is highly regulated and pretty visible, these private loans are complex, they're long-term, and they're really opaque. If a whole bunch of companies with this kind of debt all start to fail at once, untangling that mess could take years and create a huge drag on the entire financial system. Which leaves all of us with the big, unanswered, multi-trillion-dollar question. This whole system seems to work just fine when the economy is humming along. But as these private funds get bigger and bigger and bigger, lending more and more money for longer and longer periods of time, what happens if a real global downturn hits? What are the hidden risks, and who's going to be left holding the bag?